exposure. Now, is this really going to help boost growth? That's the literal question that we have. Digant Haria is with us. Digant, let's start right there. So there is an enabling framework. The RBI seems to be getting a little more liberal when it comes to capital market exposure, but still the aggregate, like Ritu explained, still capped at 40%. On acquisition financing, now, given the current caveats, the net worth criteria, the listed entity criteria, will this really take off? Or are there too many checks and balances to make a material, impact when it actually comes to, credit offtake on the wholesale side or on the corporate side?
Morning, Surbi. See, I think it's a good start. RBI, if you look at the history last 20-25 years, RBI has been very allergic to allowing banks to finance two sectors. One has always been real estate, and second, it has been this entire capital market linked, whether it is for shares, whether it is for M&A, or, whether it is share swaps or things like that. So I think what we are seeing now is a good start. And in a way, it is also an acknowledgement by RBI that a lot of growth in the future is going to come via the acquisition route. We see that a lot of large sectors in India have slowed down. So I think acquisitions will be the next leg of growth for the next 5-10 years. And, rightly so, RBI has started. See, there's always more to desire, right? The first draft can never be perfect, but I would just say it's a good start. Till now, the last 10 years, we had this route called structured financing, where guys like JM Financial or, Edelweiss or Yes Bank of the past used to do those deals. Some of those deals will come in the banking domain, but I think a lot of deals will still remain in that structured finance domain where banks are not very, very active. So I think it's a good start, and we'll pick it up from here. I think, RBI also keeps on tweaking guidelines, but the intent of RBI is very clear that we want to allow growth via all different things.
So Digant, so you don't see any implications for NBFCs or the private credit market? That will continue to thrive. You don't see banks taking away market share from them to finance this? And have you spoken to anyone in the industry? What could be the response? These are draft guidelines. It's open for feedback. What has been the feedback from the community?
Yeah, morning, Rima. See, the banking sector over last 8-10 years, they've completely shied away from this kind of financing, right? Because we saw what happened in the last 10 years. So I think banks will take time to build those expertise, to understand the product, take some risks. So I think it's a slow journey for banks. Most of them are not even very keen to do corporate finance. Like if you just look at corporate lending, except for the PSUs, the privates, they don't really have, are very gung-ho on even corporate lending. M&A financing and, these capital market related financing, that comes a stage later. So I think it takes a lot of time. I don't think it will push growth immediately for any of these banks. The private credit market, the structured finance market will continue to do well. And, guys like JM Financial who have been doing these for, ages, I think they benefit more because now they can even partner with banks for their funding. They don't just need to partner with the private equities or the sovereigns or, the institutions.
Okay. All right. Hi, Digant. Good morning. Good to hear your thoughts as always. A quick word, Digant, on the banking numbers that came over the weekend, namely Kotak Mahindra Bank. Numbers look pretty okay. Some argue that valuation-wise, it's a little expensive, but that's always been the case. So your take?
Yeah. Morning, Nigel. See, there were 15 or 16 banks which reported results over, last 3 or 4 working days, sparing the Diwali holidays. I think one theme, Nigel, is that margin compression, we were expecting anywhere between 15 to 18 bips at a sector level, but that has only come to like 7 or 8 bips. So I think the whole sector that way has done much better than what had been our anticipation. Coming to Kotak specifically, I think they had a slightly higher margin compression than, say, an ICICI or even an Axis Bank. Maybe because they were very heavy on, microfinance, personal loans, all these new products which they did in the last 2-3 years. So I think now we are at the bottom even for Kotak. Nothing to, read negative in the results. But yeah, it's just that, the good results is probably December or March is when we really enjoy the results as well. But nothing negative, Nigel.
Okay, nothing negative. Digant, unfortunately, we're out of time because we're running into market open, but we look forward to a longer conversation on some of these aspects. There are earnings, there's the regulatory change, and then there are deals galore in the BFSI space, right? So look forward to talking to you again in more detail.